So there's always a bias in terms of how we see ourselves, and that's human nature being as it is. And so it's important to be far more objective than that and say, well, how competent and confident am I in investing? And you can't rate yourself at an 8 or a 9 if you're not, because it's going to draw you into investments that are going to clash with your peace of mind. You are going to be the person that wakes up at 3 o'clock in the morning in a cold sweat going, I can't believe I've sold puts on a triple geared NASDAQ ETF. What am I doing? Because you're in the wrong place in the market for someone that's brand new. So it takes a little bit of time to work out, what slot goes into what tab and build that up. But I think if you take that approach of building your confidence and consistency up first, it makes it far easier to then make that transition into building a portfolio. Hey guys, welcome to this week's Money and Investing Show. This week we are tackling the subject of risk and reward. These are crucial things to genuinely understand. And we're going to layer this up with some very, very simple explanations initially, and then lead you through some sophisticated tools that you can use to make sure that you're playing at a level of risk that's suitable for your appetite. As always, make sure you take plenty of notes, but most importantly, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Pleasure to be here, Mr. Baxter. Thank you very much for having me. Something that we live and breathe as traders every single day is balancing risk and reward. And gee whiz, is it a tough balance? My hope for our listeners in this episode is that we can explore the metrics of risk, how to assess it versus reward, so they can better position their portfolios.
Look, couldn't agree with you more. The philosophy I've had for an awful long time now is it doesn't matter what you make, it's what you get to keep. And risk management is paramount. If you're an investor, if you're enduring life, down to your insurances and things of that nature, it's just crucial to handle risk. And yet it's the one thing I think that so many people want to bury their head in the sand and, that's never going to happen to me. I won't need to worry about that. And I think it's like pet insurance. Anytime people buy pet insurances after they've had a $5,000 vet bill and they go, I should have had some insurance to cover.
That's right.
Too late. So better to be on the front foot, and be really interesting to see where we go with this, because I am very passionate about making sure that anyone that we have interaction with, anyone in our ecosystem, becomes a ninja at risk management.
That's right. And everyone's different. The first thing I always say in pretty much all of the trade recommendations that I do to our clients is first understand the risk before the reward. Yep. That has to come first. By definition, people are more keen on losing less than they are on winning more, if that makes sense.
So it's loss aversion bias, exactly right. So that is human nature. You can risk $2, but you might make 10, or you can risk 50 cents and you might make 4 or risk the 50 cents things.
Losses loom larger than wins.
And psychologically, I think we're hardwired to avoid risk. It's part of our fight or flight mechanism from way back in the day, when we were potentially less sophisticated than what we are now. And so, it's in our DNA to be minded of that. But not everyone seems to be in that camp. And from time to time, you meet people that their attitude to risk is crimson, and that's cool. Markets are made up of all shapes and sizes of people with different risk tolerances. And I think one of the most important things, and I'm sure we'll get to this as we move through and layer this particular conversation up, is that we're not all the same when it comes to investing, and not all stocks or markets are the same either. And you have to understand what's the best fit for you. It's no different to buying a pair of shoes. You might be a size 11, but is that a US 11, a European 11? Are you a wide fit or narrow fit? They're all size 11, but there's something that's specifically for you. And if you want to be walking around, they've got to work. And investing is just the same.
Before we go into the nitty gritty, AB, let's then categorize risk and return, because they're very different. Now, risk by definition is the degree of uncertainty. If I think back to my finance degree, how do you categorize them reward? That's a little bit more open-ended.
It is, insofar as the hardest thing to do when you get into an investment is actually to hit the go button to get into it in the first place. It's kind of like, and I guess the analogy I've used plenty of times is, if you've got a car that's broken down on the side of the street, you got to work like hell to try and get it moving and push it along. But once it's moving, it becomes much easier. And I think human nature is much the same. So for a lot of people, actually hitting the go button and getting started into an investment is the hardest thing. Once you're into an investment, the next hardest thing is when are you getting out? And if something's running, that notion of, yeah, I've got a bit of profit here, but is that enough reward? So I'll just let it run. I'll stay in it. And knowing when to actually have a defined exit is crucial. And I think, this is one of the advantages of cash flow on demand as a strategy, is that your exit is predetermined if it's to the upside, and you effectively get assigned on the stock, and that's you closed out of the trade. So it sort of takes a lot of the responsibility away from people, which I think is actually a really good thing.
Begin with the end in mind, I always say.
So your reward is what you're expecting to get out of the trade. And you can have a best case scenario, middle of the road scenario, and disappointing scenario as to what they look like. And I guess, depending on the nature of the position that you're running, you might take, if it's a large equities or ETF position, you might take a little bit off the table each time, and gradually have less and less running there, taking your profits off the table. So you've got your working capital back plus a little bit, and a little bit of the free money of the profit stays in the market running for you with effectively no cost to it.
Indeed. Let's dive into risk a little bit more. Let's talk about types of risk. There's three that spring to mind. There's market risk, sector risk, and then stock specific. Let's start with market risk.
Yeah, look, I mean, market risk is that bump and major sell-off across that's broad-based.
So that's everything, right? Every sector, every stock.
Everything's tied with the same brush. No one wants it. Yeah, we saw it through the GFC, which was a very broad market sell-off, even though it was actually caused by a sector. We saw it through eventually the tech wreck, albeit again in the technology sector. We saw it through the pandemic. And even more recently, it was kicked off in the tech sector, but we saw the whole market sell off. So this could come about through an act of terror. If we think about the events of 9/11, pandemic in the case of what we saw a few years ago, a force majeure, a war of some description, any of those things, and it's where everyone's out of that asset class. They just want to sell. They don't care the price. Just get me out.
Well, stocks are by definition pretty correlated across the board, no matter what sector or area they're in. If there's a broad market sell-off, chances are if you're holding a stock, it's going to be lower.
Yeah, I mean, that's a fair point, because they are the same asset class, and people typically make asset class decisions rather than individual stocks. And if you've got something that's affecting that asset class, then it applies to everything anyone out.
What about sector specific?
So sector specific would be where there's news that pertains to that particular, as its name would suggest, sector. So a couple of examples. We talked previously about the tech wreck, where technology was the place to be through sort of 2000, 2001, and then May it wasn't, and that area got sold down very, very heavily. Other examples of that might be, let's take an example of airlines. That's a sector, and let's say there was some news that affected airlines. Maybe it was a
plane dropped out of the sky.
Plane dropped out of the sky is a good example of that. And all airlines typically sell off on the back of that kind of thing. So it's something that's very sector specific, and directly and immediately has an impact to that. Equally, on the positive side of things, if you think about through the pandemic, the pharmaceutical sector did especially well. It was something that was sector specific because of the development of vaccinations, and so that was something that was boom times. A change in legislation, so tobacco would be a good example of that, where if legislation is brought in that targets a particular thing, albeit tobacco in this case, then you can expect that sector to sell off. So AI on the upside, anything that's related to that has done well. So it's news that pertains to that particular grouping across the board within markets.
The big thing for listeners there is the contagion effect. So we use the plane dropping out of the sky. Yeah. Let's just say it's one particular airline which has many problems with its aircraft. It might not be related to any other airline that you might be holding as a stock, but it's going to bleed across.
What it does, it highlights risk.
Correct.
So you perhaps have been investing in a certain way, something's happening, you go, I hadn't factored that in as an example. If you were to take banking, a bank might have a particular charge against it, maybe a significant loan write-off, and that prompts anyone that's holding banking stocks to look at, well, what if that happened to this? And you do tend to see money run out the door on the back of those sorts of things. The mining sector, if you see iron ore prices drop away, then it's going to affect all stocks in the iron ore space, not just one or two.
Gee, it's a tough game, isn't it? Why do we play it?
Look, it gets us out of bed in the morning and probably gives us something to think about in the middle of the night.
That's right. What about stock specific? Now, if we want to get technical with this is idiosyncratic risk. So this pertains directly to that business only.
Okay, so a good example of that would be Boeing, where there's been some question marks over manufacturing quality, which is a pretty important piece of the puzzle. If you're in aircraft manufacture, you don't want deficiencies in safety or safety standards. So that's something that's affected that stock more than maybe other stocks in that specific sector, because the news has been very much around that. If you look at the car industry, Tesla's sales figures have been not great over the last couple of quarters. So it's had a direct and immediate impact on their stock price, but that's not something that's bled across to other automobile manufacturers because it pertains specifically to Tesla.
Change in management, one too. Yeah, company specific.
Change in management. You look at Qantas. We covered that fairly adequately, I think, a number of months ago in terms of some poor boardroom decisions denigrating the brand. Interesting to see that they clawed some of his money back, which I think was something that we put forward in that podcast.
I'm sure he had a few to spare.
But that's stuff that's pertinent to a stock specifically. And I guess when you look at that, the further you move into the granular of investing in an individual stock versus a sector versus an index or a broader market, the more stock specific your investment strategy, inherently there's the potential for there to be more risk.
So big question here, how do you actually assess risk? How do you make that judgment call?
Look, one of the tools I use, and this is really important because for our audience listening to this, not all shares are the same. And a lot of people, for example, will have a buddy at work or a family member that trades or invests, and they kind of piggyback on what they're doing, or that maybe it's a newsletter or something they subscribe to, and they'll just take trades because they're put forward or somebody else is doing them, but they may not suit you. And again, we'll get into the nuances of working out what's important to you as we go through. So the way I liken this, forget about trading and investing. Let's talk about curry. Being British, I guess, I've had plenty of experience.
Keep warm.
Eating curry. And if you've got someone that's never invested before, right, and we'll use this as a parallel, and you've got someone that's never eaten Indian food before.
Okay.
If you took that person to an Indian restaurant and said, listen, don't worry about ordering, I'll order for you, and you order the hottest vindaloo that's on the menu, the chances are it's not going to be a very pleasant experience for that person.
That day or the next day.
Chili burns twice. So the reality is they probably wouldn't be in a hurry to go back and have Indian food again. So you've taken someone, exposed them to something that's way too hot for their taste buds. It's not pleasant. They'll shut the door. What would have made far more sense is to say, look, you're new to this, so why don't we get you a really mild butter chicken or a chicken korma? We'll get you some reti, really mild, see if you like it. And then over a period of time, as your taste buds evolve, we can start to move through the spice spectrum until you get to that level where you go, that I'm good there. Well, really, trading and investing is exactly the same. And there are stocks within different sectors that some are very spicy and some are very mild. And when you're starting out, mild stocks that don't have large levels of volatility and they're not especially spicy would be far more important to you to build your confidence up than diving into something that's really spicy and moves all over the place. And if we were to talk about iron ore, seeing as we've mentioned it previously, Fortescue Metals, great business, but really its business is quite narrow. It digs iron ore out of the ground and largely sells it to China. If you were to compare that, so it's a spicy business.
Concentrated, right?
Very, very concentrated. And on the other end of the scale, if you took BHP or Rio, they're diversified and they sell products all over the world. They mine all over the world. So they're all miners, but Fortescue would in of itself be a little bit more volatile and more spicy if we use the example that I've got. So if you're brand new, what you would look through if you're an investor, and I'll take this back to what people's goals are in just a moment, that's probably one that would leap off the page. You go, look, I can make all this money here, but it's going to be a very uncomfortable ride because of its volatility or spiciness, where it makes far more sense to be in something that's slower moving, where you're learning the ropes. So if we just go back to goals for a moment on this. So, and I had this with my very first client that I taught how to trade here in Australia. I asked him what his goal was, and he said to make money, which, profitable, that's obviously a goal for any trader, but it's not the main goal. And I know that sounds a little bit strange. The previous two goals that are more important, at least in my opinion, would be, number one is consistency. And then number two is confidence. Because firstly, you've got to have a process that's going to enable you to feel and be more consistent in what you're doing, that manages your emotion out of the way and lets you just pull the lever when it's a trade. And then after you've seen some level of success with that, your confidence will grow and you'll probably start to scale. And that's ultimately where you'll become profitable. But if you miss those first two steps and just pile into the market in the hope of being profitable without having a process that's going to give you consistency and without doing the work to believe in that process to build your confidence, you're punting. And that's never going to end well. We're talking about risk and reward. That is very, very risky. In fact, the worst thing that can happen is you have some immediate success. And I know this sounds so sort of, I guess, the opposite of what people would expect to hear. The worst thing you can have as a brand new trader with no process is immense success, because you're going to start scaling based on luck, and that's not going to last. And when it doesn't, you're going to really do yourself some damage. Whereas if you've done the work and grown into it, you're going to get there safely. So going back to our example here, having something that's less spicy is going to enable you to build more confidence, and it's going to enable you to have more consistency. So that's why it's important to get those goals really nailed. So the measure for spiciness, you can't just go, oh, that company's more spicy than another. It's a very subjective way of doing it. So the tool that I use and what I encourage our clients to use is something called implied volatility. Now, IV is the name or the abbreviation, the acronym for implied volatility. Any indicator that you put on a stock chart, as you well know, looks at the left side of the chart, what's happened. It's a lagging historical measure of how things are going. Because of the way options work, implied volatility has the ability to look forward at what's expected. Is the company coming out with an earnings announcement? Is it affected by
economic events
such as interest rates or employment data or manufacturing or CPI, whatever it may be?
All factored in, right?
All factored in to that option, and therefore into the option's implied volatility. So if the IV starts to increase, there's more risk associated with that stock. It's becoming more spicy at this particular time. And depending on where you are in terms of your personal development, you can elect to let that one go through because it's going to be too hot to handle, or you can get on it if your skill set is really there. And I find that to be a very, very practical, not ambiguous and not subjective measure for people to use.
Indeed. I think particularly, yes, as you say, stock specific, you have to understand the business and the IV. If we then take this to the next step, AB, which is positioning a portfolio, understanding where the bets are placed insofar as if you've got all of your money or the majority of it in a higher risk industry, and let's just compare, say, energy versus something like healthcare. We know that energy stocks are traditionally more volatile than something like a healthcare stock because it's more defensive industry. Understanding how to then carve that up is the next question. Now, that's a pretty sophisticated skill. How does even the most basic listener on today's episode start to do that?
The approach I'd suggest, I've developed a model, I call it the solar system model. And that's where, probably 60% of your portfolio is in the lower risk asset. Big diversified index as an example of that.
So something like SPY as an example, S&P 500 ETF?
Or the Qs would be examples of that, or the bond market.
Yep.
And that way, the biggest slab of cash that you have is in the lowest spicy instrument that you can be in. And the index in itself is always going to be less volatile than an individual share because it's diversified. If you think about the S&P 500, as its name would suggest, it's got 500 stocks in it.
All in that one holding.
If one of the stocks tanks, the other 499 are holding up, then your investment will hold up. So what you're doing is removing stock-specific risk, which is very, very important when you're starting out. I would then move across through two other categories. One would be my sectors and a structure where you've maybe got about 30% of your portfolio across some of the sectors. And then the last 10% is what I call my hot dogs. And I think the reason I like them is it gives me the ability to have some color in my portfolio rather than just simply a broad index-based tracking system. And that small weighting to that end, when they perform really well, can make quite a difference to the account. But your overall risk is relatively low because it's really only like a small amount of money you got there.
As you progress further down the line too, you can dial this up or down. Yep. The important question, though, that we do have to ask is understanding how your goals align with your risk tolerance, aligns with your risk. So as we finish off today's episode, AB, understanding your tolerance and how they actually align with your goals has to be the foundation of everything.
It does. And it comes back to those initial three questions of, number one, your goal can't just be profit. It's got to be consistency and confidence, first of all. And it's very hard to look at yourself in the mirror and say, how confident are you? Because there's always a bias in any sort of sample. It's the Lake Wobbegong experiment, which is a really interesting one if you haven't heard of it, for anyone listening. And it's where if you ask someone how they rate themselves, typically it will be above average. And we've done this live at events. So I think the last time we did this, we had maybe 400 or 500 people in a room.
Oof.
And we said, okay, how many, write down where you are in terms of how well you rate your driving skills. Everyone's written a number. So, right, and then we just had the numbers 1 to 10 on the wall, go and stand in front of your number. And I think 85% of the room were 6, 7, 8, 9, 10. And then and everyone else was probably about 5, and there was like one person rated themselves as a 3.
At least they're honest.
If you said, how intelligent do you think you are, most people would overassess. How attractive do you think you are? How funny do you think you are? How well are you tracking in life? All those things. So there's always a bias in terms of how we see ourselves, and that's human nature being as it is. And so it's important to be far more objective than that and say, well, how competent and confident am I in investing? And you can't rate yourself at an 8 or a 9 if you're not, because it's going to draw you into investments that are going to clash with your peace of mind. You are going to be the person that wakes up at 3 o'clock in the morning in a cold sweat going, I can't believe I've sold puts on a triple geared NASDAQ ETF. What am I doing? Because you're in the wrong place in the market for someone that's brand new. So it takes a little bit of time to work out, what slot goes into what tab and build that up. But I think if you take that approach of building your confidence and consistency up first, it makes it far easier to then make that transition into building a portfolio. There's nothing worse than seeing someone in a portfolio that's manifestly inappropriate for them, because they lose that peace of mind, which is tragic. And when you lose your peace of mind, your confidence goes. And once your confidence goes, your action threshold is far higher. So it means you're going to do far less and you stop making progress towards your goals.
Totally.
And I really feel for people when I meet them like that, because it's not their fault. They've been pushed into something without really understanding the mechanism or process through which to get there. And it's ironic that we're talking about risk and reward, because that's a really good example of someone that's been sold the reward without really understanding their risk.
Totally.
And that, to me, is probably one of the major reasons why we're in financial education, to help people understand where on the curry menu, getting a bit peckish thinking about all this food.
Me too.
See who's buying lunch today in a moment, but where you're sitting on the menu that's right for you. And it's going to be different from the next person, and it may well be different from your partner. If you're in a self-managed super, that can be quite interesting. If one or other members of the fund has got a more aggressive attitude to risk than the other, how do you manage that? And that's all stuff that we teach.
You can quantify this as well. One thing that jumps out at me is probably our trading psychology program, because we talk about equity curves, Sharpe ratios, edge ratios, which is, when you look at your performance, a really good way to adjust your strategy moving forward based on what your tolerance is.
They're professional tools. And at the end of the day, if you want to get professional results, you have to use professional tools. You can't just read the tea leaves and hope it's going to work out for you. So these sorts of things all layer up. So understanding, consistency, then confidence, then profitability. How do you build up your consistency? You've got to know your numbers. And once you've got that consistent win-loss ratio, for example, happening, and your Sharpe ratio starts to improve, when you look at your equity curve, it starts to smooth out. You don't have those big gains and those big losses. It's just predictably, boringly going in the direction that you want. And that's where your confidence then grows so that you can scale. And that's really where your net profitability really starts to turn around. It's all interwoven, and it seems an awful lot for people to digest straight off the bat, because you think, oh, that's risky. Stock market's risky. Well, we've just gone through how it's not. It's different aspects of the stock market can be either more or less risky than others. Taking the time to do that work is crucial. Our trading psychology course, as you mentioned, is all about that emotional control and using those professional tools to help you, so that you're not feeling like you should be doing something, but objectively you've got benchmarking and modeling. And you look at the world's best investors. Let's take Ray Dalio. I've just finished another one of Ray's books, and it's just been insanely good reading, because you've got a guy that, look, doesn't need any introduction, but for the benefit of those that may not, he's a founder of the world's largest hedge fund. In fact, been embryonic in the hedge fund business in terms of developing financial modeling, which everybody now uses. They were first, they're the best at it. And none of that is based on feel or intuition. There's no, oh yeah, I'm telling you this is going to happen because I've seen it before. It's all based on statistical modeling that they've done for decades and decades. And so if you want to get professional results, you have to use professional tools. And that starts with understanding a quantum or an actual number way of managing risk. We talked about spiciness using IV, which is a reasonably sophisticated tool. And it's also dynamic. It changes with the stock. We've also talked about what your goals need to be if you want to be successful in this space. Firstly, consistency. Then confidence. How do you measure your consistency? Oh, I feel like it's going well. No, you've got to look at the Sharpe ratio, and we can explain in detail exactly how you go construct that. When it's hitting a level where you're at, then you can start to scale. When you start to scale, that's where your profitability is going to come. If you miss step 1 and 2, all you're going to do is scale problems, and that's where you're going to lose a truckload of money, and that is very high risk with no real reward.
And definitely not what we want for our listeners, AB. Thank you for the advice. Great episode.
Absolute pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.